Have reached our chief guest for valedictory session is already here, Deputy Governor RBI Shri Rajeshwar Rao. So we will be summarizing most of the key takeaways. Jagjit, takeaways. So may I request Jagjit Sareen, he is Area Chair, Climate Initiatives at CIU, to give us the lowdown and summarize today's conference.
Thank you, Anlesh. You always give me such easy jobs. I thought you were my friend. Anyway, let me attempt. It was such a rich discussion since morning, and it would be very difficult to summarize, but I'll perhaps share my key takeaways. First of all, I think everybody recognizes the key and pivotal role NBFCs play in providing financing to the last mile. And I think in this transition, a green transition, which India, whole of government, whole of stakeholders have now agreed to embark on, NBFC's role again is recognized. And the discussions teased out elements to strengthen the balance sheets of NBFCs and their capacity to understand the climate risk, productize it, and provide necessary financing to MSMEs and beyond, for them to address both mitigation opportunities, but also help adapt and build their resilience, because there's going to be a lot of climate hazards impacting the supply chains and assets of NBFCs and their clients. The other bit of discussions we had were also at the macro level. In terms of, in this changing macro or geopolitical environment, how would the additional credit be provided to the country and to intermediated through the banks and NBFCs, and what it does to the cost of capital, the tenure, the complexity of it. We also had rich discussion on the regulatory side. What are the key regulatory unblocks for NBFCs to play a larger role? There was also a set of discussions around the need for a new green financing institution, sir. And many of the people who have been working with Niti Aayog and some independent stakeholders also provided their view, both positive and critique of having a new financial institution focused on green. I think where we ended up there is that we still need to do some work bringing the demand side clarity from, especially from the private sector and potential beneficiaries of such green credit as we expedite our green transition. We had very senior speakers from Jayant Sinha ji to Shamika Ravi ji, and now Deputy Governor himself is here, and former MOS External Affairs Meenakshi ji, who guided us on the macro policy issues, the experience of India, and I think reinforced the confidence that it has to be an India way of doing things. We cannot emulate the examples, the models wholesale from the global north. We have to chart our own ways, given our developmental challenges, our entrepreneurial energy, the startup enthusiasm, the fintech enthusiasm, and how it all has informed and influenced the banking sector, the whole credit ecosystem. So just to summarize where we are at, I think there have been a couple of takeaways, if you ask me personally as a practitioner in this space, that first of all, it's heartening to see that CIU has embraced the green agenda wholeheartedly. And this credit summit is focused on green, and then they are going to the capital markets. In NSE and banking conclave would also be focusing on the green agenda. Being the climate area chair of CIU, I can take some little credit for that, and under the leadership of Ashwini ji, that we are moving ahead. I think there was also a recognition from the discussion that we need to expedite our pace. and we need more money, and we need to empower and unblock the regulatory hurdles around NBFCs. And the final point was on this need of a new institution. I think that requires a bit more deeper consultations. And with those insights, sir, I thank you, your attention, and also thank the attention of the audience. Thank you very much.
Thank you, Jagjit. Now may I request Dr. Ashni Mahajan, Mrs. Meenakshi Lekhi to come forward and escort our chief guest, Shri Rajeshwar Rao. Rao Saab has traveled from Mumbai especially to take part of Credit Summit. So I think he deserves a round of applause. And the applause should not end till he reaches the stage at least. So thank you for taking your time out and being part of us. So Mike is next to you. We are ready to hear your address, sir. You want to take this? Yeah, most welcome. If you want to sit and talk, there is also no problem.
Distinguished guests, participants, ladies and gentlemen, a very good afternoon to all of you. At the outset, let me thank the organizers for inviting me and giving me an opportunity to deliver the valedictory address and share some of my thoughts on a subject which continues to engage the nation and also attracts the global attention. I believe there would have been several fruitful deliberations on the topic of green and sustainable finance and the role of institutions, opportunities and challenges. I had the occasion to hear the summing up of the sessions. I think it would have been quite interesting. And each of the topics which have been flagged requires detailed deliberations, and collectively they actually form the building blocks for creating a robust ecosystem for green and sustainable finance for the economy and the financial system at large. The critical enablers to attract green and sustainable investments that need to be put in place for financial ecosystem has been and continues to be the subject of deliberations at various fora, be it the G20 Sustainable Finance Working Group, the international standard setting bodies such as the Basel Committee on Banking Supervision, the International Sustainability Standards Board, as well as the Financial Stability Board, as well as at the Network of Central Banks for Greening the Financial Systems, the NGFS. These enablers range from adoption of a national green and climate finance taxonomy, globally aligned disclosure standards for climate-related financial risks, as well as robust assurance and a verification process. Green and sustainable finance, being a niche area, further requires us to be mindful of greenwashing risks. Moreover, there are certain inherent risks and conditions that need to be met from the risk-reward perspective in green and sustainable lending or investment decisions. Let me delve a bit into these aspects and try to build a narrative on how we can collectively build and develop a robust ecosystem for green and sustainable finance in India. When we talk about green and sustainable finance, the primary consideration is understanding as to what actually defines it. A national level taxonomy is crucial for this, as it serves as the first building block that aligns the entire ecosystem, be it the government, the regulators, the other policymakers, financial institutions, as well as the borrowers and the investors. This is It's right now a work in process. You are aware that an announcement to this effect was made by the Honorable Finance Minister in the budget speech of 24-25. Meanwhile, at the Reserve Bank, we have at this juncture used the framework for sovereign green bonds for mapping the green and sustainable sectors. This was also used by us when we issued a framework for acceptance of green deposits in April 2023, which aligns with the sovereign green bond framework towards identification of the green sectors. Thus, as a robust ecosystem enabler, the first building block would be the national level taxonomy for identification of the sectors and alignment of the various regulatory dispensations along this taxonomy. The second building block would be a consistent and harmonized regulatory approach towards assessment of climate change risks and fostering of related financing. The climate change risks and the related issues are sector agnostic with significant interdependencies. In order to ensure that the zero target announced by the Honorable Prime Minister at the COP26 in 2021 is achieved by 2070, it would require the players in the economy and the financial system to fine-tune their respective actions and measures so that as a country we can achieve this target. It would also require a consistent and harmonized approach among the regulators and the authorities concerned. The next building block would be the development of a robust assurance and verification process. Assessment of climate-related financial risks, green and sustainable finance are context-specific with need for a clear and objective demonstration of the end use of funds. Transparency and related checks and balances that provide the assurance on the end use of the funds related to green and sustainable finance is extremely important. Given the technical expertise needed for assurance on climate-related aspects, as well as adherence to the benchmark assurance standards, there is a need to ensure credibility of this assurance and verification processes. This would, in essence, mean defining the requirement of consistent standards, detailing expertise and skills that any assurer or verifier must possess in order to provide these services. A consistent approach across the financial system on the processes would provide confidence to the investors, which would then operate as a key enabler to increased flow of credit to the relevant sectors while addressing concerns around greenwashing. The fourth aspect is the need for transparency in the climate-related disclosures. This is essential for financial institutions to assess and manage climate-related financial risks, ensure transparency and support long-term financial stability. This also underscores the need for coherence among the various sectors on disclosure aspects. To give an example, if a financial institution has to make any lending or investment decision or assess its portfolio risks or is mandated to make climate-related financial disclosures, then it has to depend on the borrower to provide the requisite information. This means not just putting in place an enabling mechanism for both the lender and the borrower, but also having consistency across the financial system for seamless flow of data and information. The Reserve Bank of India has published a draft disclosure framework for climate-related financial risks in February 2024 for public consultation. The draft guidelines requires the regulated entities to make qualitative and quantitative disclosures based on four broad areas, that is governance, strategy, risk management, as well as metrics and targets. We have received comprehensive feedback on the framework which are being examined. Another area where consistency and harmonization are required is in the compilation of data. For the purpose of climate-related financial risk assessment and related facets of green and sustainable finance, be it transition or adaptation finance, data is very crucial. One of the limitations of climate risk assessment at this point in time is the need for technical expertise coupled with unique data requirements. Climate-related data, understanding the nuances of climate patterns and impact on account of climate change is a highly technical and skilled job. Climate scientists across the world use supercomputers to study climate and weather patterns and its related aspects. It involves complex modeling and is resource intensive. If we depend on a financial sector expert who uses financial modeling for assessing quantitative estimates and arriving at the financial sector impact, this expertise alone may not suffice. The two skill sets of climate scenario analysis and climate finance risks are completely different in that climate scientists are not experts in financial modeling and financial modelers have limited expertise in area of climate science. This makes the job of assessment of impact of climate risks on the financial sector all the more difficult and would require collaboration amongst the two streams. Given the impact of climate change risks, physical and transition risks, and the impact it has on the value of real assets and financial instruments, understanding these risks is crucial for lenders or investors from a risk-reward perspective. Thus, for uniform and consistent assessment of risks across the financial system, the aspect of disclosure and data becomes crucial. This will remove the misalignment of information amongst the borrowers and lenders and investors, and not only allow a fair assessment of climate change risks, but also foster green and sustainable finance. As a part of this endeavor, the Reserve Bank had in its monetary policy statement of October 24 announced the formation of the Reserve Bank Climate Risk Information System, RBCRIS. RBCRIS is envisaged to bridge the data gaps and provide standardized data sets to the regulated entities on three aspects: physical risk data, transition risk data, and carbon emission factor database. The physical risk data part would provide on providing pan-India hazard and vulnerability data. As regards the transition risk, the plan is to arrive at an India-specific transition scenario and use them to provide sectoral transition benchmarks. Finally, recognizing the need to standardize the emission calculation across sectors, a consistent approach towards carbon emission methodology and uniform database is being proposed. Under the RBI-CRIS, RBI intends to bring all the stakeholders together and bring coherence and bridge the existing data gaps. Climate change risks impact the financial institutions, the system, and the real economy through traditional risk categories, and one risk factor that stands out prominently is credit risk. Climate change would lead to additional operational costs for borrowers with an increased probability of loss of their assets, leading to increased probability of default by the borrowers. The real economy is also impacted through several means such as direct property losses, crop losses, loss of employment, and livelihood. Another facet of credit risk in climate change emanates from the need to promote green and sustainable financing. The fact that net zero technologies driving the transition to decarbonization are at various developmental and evolving stages itself signifies a significant increase in the credit risks. Thus, there is a dichotomy wherein on one hand there is a need for incentivizing green and sustainable financing, on the other there is an increase in the inherent risk from encouraging such financing. So the key issue is how to manage this dichotomy. While the prudential aspect, the risk management considerations, is the prime concern for any regulator, the flow of credit is generally market determined, albeit mandated at times through specific directed lending policies. Therefore, there has to be a delicate balancing act to be performed by the regulators so as to avoid any imbalance from the broader financial stability perspective. Challenges to green and sustainable finance are many. However, they can be broadly categorized into two specific buckets. One is the structural issue, while the other relates to the quantum of financing available. From the structural perspective, the main challenges would be high upfront capex requirements given the specific nature of the required project loans and investments, perceived high inherent risk given the evolving nature of climate-related technologies, the asset liability mismatches which are ubiquitous to any lending or investment activity, more so in the case of project loans given for longer maturity, the commissioning and gestation timelines, and the knowledge and information gaps given the technical nature of assessment of climate change risks and the appraisal of climate-related technologies. As to the quantum of financing available, there are various pull and push factors at work in the context of global capital mobilization. The global capital stock of lending and investment flows also follows a risk-reward perspective. The pull factors are specific domestic enablers that may drive the investor appetite. This would be a function of the robustness of the financial ecosystem, the liquidity and depth of the financial markets, the transparency and disclosure standards, the rigor of the verification and the assurance processes, development and dissemination of the risk assessment models for climate-related data, risks, data, and capacity gaps, the long-term strategy on transition plans, and the available pool of bankable projects. The push factor would be the global commitment of funds for climate-related funding. The recent geopolitical developments could possibly lead to weakening of these push factors. This is a developing story and there is a need to closely monitor the wider implications. Given the huge requirement of funding for the green transition, availability of global funding remains critical. The inherent risks in the green and sustainable finance skews many risk-reward considerations leading to increased cost of credit. This leads to demand by private sector investors or lenders for appropriate de-risking mechanisms through grants, guarantees, philanthropic capital, financial incentives, to cite a few. Mobilizing such capital on scale would be a challenge. A related issue is the availability of bankable projects. Though bankable projects invariably find credit, there are funding challenges with partially bankable or non-bankable projects. As you all may be aware, there are two aspects to climate change finance we need to consider. One is mitigation and the other is adaptation. Mitigation is used for transition purpose and adaptation for resilience. Financing in case of mitigation can be associated with cash flows, but it becomes difficult for adaptation and resilience, as the associated cash flows are difficult to assess, leading to suboptimal capital flows towards sustainable investments in the resilience infrastructure and for adaptation. Given these limitations, there is a need for a concerted effort to overcome these challenges and augment green and sustainable finance. This would require a multi-pronged approach. Blended finance, which combines concessional public funding with private sector investment, can be one of the main conduits for the credit flow by de-risking climate-related projects. India is a diverse country with varying needs for climate mitigation and resilience, meaning a coastal area would require a differentiated approach compared to the regions near the Himalayas. We would need practical implementable solutions curated to the specific issues. Tools like guarantees, sustainability-linked loans, and climate-resilient bonds need to be explored to further enhance private sector involvement. The problem of climate change needs scalable solutions and it cannot come by entirely relying on public funds. Thus, there is a need to develop a market where a risk-reward perspective takes care of the scale of requirements. Even within the adaptation space, there are pockets which can be associated with cash flows. Climate change risks and financing needs need to be viewed also as an opportunity, and innovative solutions which not only mitigate financial risks associated with climate change, but also incentivize private investors to participate in climate projects need to be explored. Developmental financial institutions would have to play a major role in channelizing the flow of credit for green and sustainable finance. There is a need for more collaboration between the developmental financial institutions, the multilateral development banks, the national development banks, and the vertical climate and environment funds. Given the current geopolitical developments with the world moving to a multipolar world, there is a need for certain reforms within the MDBs, as well as greater representation from or credit to the global south. Technology and innovation would play a major role in mitigation of climate change risks, while creating a robust ecosystem for green and sustainable finance in the country. This requires developing a platform which would bring together the regulated entities and the technology solution providers to facilitate an orderly development of the required technological solutions to mitigate climate-related risks and overcome the current limitations, and also foster sustainability-linked credit flows. Reserve Bank in April had included sustainable finance and climate risk mitigation as a topic under the theme-neutral on-tap facility for regulatory sandbox, which could help to develop and test innovative solutions. One term which often finds mention in the global context has been interoperability. While as a concept, interoperability seems ideal in a just and equal world, in these times, in a world with stark inequalities, mandating interoperability with similar level of commitments may not be the ideal way, and there's a need for a differentiated approach. The emerging markets and developing economies have started this journey to achieve seamless integration and interoperability, but there is quite some distance to be covered. Though historical examples from high-income countries demonstrate the potential to decouple economic growth from emissions, for EMEs, this would require strong international cooperation, significant investments, and effective policies. Further, any transition from a carbon-intensive economy to a greener economy is not going to be a smooth ride, and there are going to be disruptions, be it restructuring, reallocation of resources, and financial flows, as also displacement of workers, and has also a bearing on the land use. Thus, as we traverse this journey, there's a need for a delicate balance to ensure that the socio-economic implications are carefully considered and addressed. Going forward, we would also need to arm our respective organizations with skilled manpower and technical expertise to spearhead the transformation in addressing the challenges of climate change. With this end in view, the Reserve Bank has been conducting extensive capacity building programs for the regulated entities. The focus has been on bringing international experts to share their experience on green and sustainable finance, stress testing and scenario analysis, credit risk assessment, transition planning, physical risk assessment, and global best practices for governance, strategy, and risk management. India occupies a unique position in the global climate context. As one of the world's fastest growing economies, it faces the dual challenge of fostering and sustaining economic development while addressing climate change. On one hand, it is highly vulnerable to climate risks, while on the other, it has the potential to lead the global green transition. While we have made a fair start, there are several challenges that remain to be addressed. The risk management architecture in the regulated entities for climate-related financial risks is still evolving, and further concerted efforts are required. Further, a comprehensive assessment on the extent of losses that may be caused due to climate change risks in the future requires more granular approach. There is a need to build technical expertise and competencies for comprehensive assessment and mitigation of climate change risks. There is also a need for a more harmonized and coherent regulatory approach across the various sectors so that the sectoral dependencies may be addressed in an efficient manner. While the need for the world to transition to a greener tomorrow is a given, there are several challenges on the way, and these need to be addressed in a holistic manner. We also need a collaborative and sensitive approach to address the various issues, given the impact on the economies and societies at large. I am confident seminars such as these give an opportunity to further the work to achieve these objectives. Thank you very much. Good day to you all. Jai Hind.
Thank you, sir. Thank you. Thanks for very insightful and very thought-provoking remarks, sir. Now, may I request Raman Agarwal to come forward and propose a vote of thanks.
Honorable Deputy Governor Rajeshwar Rao ji, Honorable Madam Meenakshi Lekhi ji and Ashwini Mahajan ji, all friends from the media and ladies and gentlemen. I think the entire day's session were very aptly summed up and very nicely put by the august presence of Rajeshwar Rao ji. And sir, your address covered almost the entire aspects of this aspect when you talked about the sustainable finance and the efforts being made at RBI, and especially during discussions we were talking about this RBI's draft guidelines on the climate risk, climate change risks which the financial institutions carry on the balance sheet, and how to identify and mitigate that risk. So during the day we'd had a very exhaustive set of discussions on this entire ecosystem of funding, not only the green finance but green assets, and the role of financial institutions like NBFCs in this context. And sir, with your permission, once we have compiled things, we would like to compile this and what the outcomes of this today's, and maybe seek your audience sometimes and share with you the outputs of today's deliberations, and certainly seek RBI's support on this venture. So thank you once again, and thank you all for joining us today. And let me also take this opportunity to thank our partners, the sponsors for today's event, SIDBI, Cholamandalam Finance, GMI Finance, and PTC India Financial Services for their support. Thank you. Back to Anilesh.
Thank you, sir. Thank you, Raman. Thank you very much. As a custom, sir, we pay gratitude to our guests, and we give a very humble, pot. So there's a jet plant which we are giving to all our participants. So it's a symbol of green. May I request Jagjit and Raman come forward and please play our gratitude. Honorable Deputy Governor, Shri Rajeshwar Rao ji, thank you very much. Madam Meenakshi Lekhi, this is for you. And Dr. Ashwini Mahajan. So with this, we thank our knowledge partners, Dalberg Advisors, the Shamlav Advisors, CPI, Climate Bond, CEEW. May I request their leadership if they can also come forward and have a family picture. They all have worked really hard to stitch together Credit Summit. Dhruba, if I could see you, Neha, Vivek, if you can come forward. Richa and Ben, if I can't see you all guys, come forward. Neha, the other Neha also. Where is she? Neha 1, Neha 2, please both come. चरण जी आप ही आइए. Ladies and gentlemen, with this, the frame becomes broader now. Thank you, everyone. A round of applause for you as well. You stayed back the whole day and made this Credit Summit a really a good success. Thank you very much. The tea and coffee is served next door. We all will be taking the tea and then disperse. Thank you. And thank you, everyone.